It's been hailed as one of the most significant events in the history of the crypto ecosystem. The long-anticipated Ethereum Merge has successfully occurred without a hitch, transitioning Ethereum from a proof-of-work to a proof-of-stake blockchain. But despite the positive development, crypto markets are still very much feeling the chill of the macro environment. And my next guest says expect the crypto winter and the everything winter to last longer and get much colder as the Fed gets more aggressive. Joining me now is Mike McGlone, the Senior Commodity Strategist at Bloomberg Intelligence. Mike, welcome back.
Hello, Michelle. Thanks for having me back.
All right, Mike, let's start off with the merge. The massive overhaul of Ethereum has finally happened. The upgrade now making Ethereum 99% more energy efficient with proof of stake or validators replacing the miners or the proof of work protocol. Now, this was no small feat. In fact, many described it as switching a plane engine in mid-flight. But after several delays, we did have a very smooth transition. All went well on the technical side. How significant is the merge?
Well, it's good that we've got this period over with. I think the key thing to realize here, it's got a pretty good pump with all the publicity, and it's risking a significant reversion back towards $1,000. I think the big picture to think about with Ethereum is it's revolutionary. Just like I came from the futures pits and they revolutionized finance. It's revolutionizing finance like futures and ETFs. But right now, we get through this merge, and we have to worry about potential bumps in the road, which we all know happens with this kind of technology. And remember, I'm a markets guy, the technology guy. I depend on other technology stuff. I depend on other people for it. But the thing is now, then we have to turn over to the macro big picture. What's been pressuring cryptos this year? And that is the Fed sledgehammer. And I think that's my focus. I mean, I've written about Ethereum and just kind of lighten up a little bit with all this merge talk because I'm just afraid it got too hyped, and now now let's do it. And I'm worried about the short-term pain for a longer-term gain in all markets.
All right, well, we did see the price falling around 8% today. Many thought that this was a case of buy the rumor, sell the news. Is that what you think happened here? The good news priced in, or do you make it more of a lot of anticipation ahead of the Fed meeting next week?
Well, there you go. Definitely a lot of the good news priced in for the short term, but it's within a significant macroeconomic, broad-based bear market for all risk assets. I mean, even housing markets turning over. Even bonds are down. It's that macro, and it actually might be one of the biggest bear markets in most of our lifetimes. And I'm almost 60 years old, and I think it's just early days because I've never seen this before, Michelle. We have that much aggression from the Federal Reserve, and within a market, a global economy that's really tilting significantly towards recession. I mean, we have a Bloomberg Economics tracker that's pretty seriously a good indicator in 2008. It's gone negative for a global economics tracker. So that's the macro. You dig into the cryptos, and I think what's happening is what's really happened this year is the markets realize that this Bitcoin thing is one of the world's most significant leading real-time 24/7 traded leading indicators. It's just indisputable now. I mean, it come Friday happy hour, that's when you really see it. And Saturday, you see what's going on. And Sunday, you see what's going on. And it's signaling risk off in one of the most significant risk off markets I've ever seen. I think we're going to see more of that, but I think it's going to come out ahead. Bitcoin particularly, because I think Bitcoin's going to be trade more like U.S. long bonds and gold, which had a problem today, which is indicative of the problem. And Ethereum's so revolutionary because one thing that's most notable, I like to point about Ethereum, it's making the most significant thing happen that I just find revolutionary, and that is the tokenization of assets. Most notably, the most widely traded crypto on the planet, our tokens are dollars. Ethereum made that happen. Yes, there's competitors, but Ethereum was the leader. Tether's one of them. There's a dozen crypto dollar wannabes. People call them stablecoins, but people are realizing how revolutionary this technology is. And they all know, most people realize, okay, I've got to adopt or fall behind. Now, what does that mean for the price of Ether? Okay, might go back to 1,000, might even get a bit lower. And I think in the next 5-10 years, it's going to go much higher. But right now, the key thing for all cryptos is they're about $1 trillion space. The global equity market's 100 trillion. It's already lost 20. It's probably going to lose another 20. And I don't see what stops that right now. That's the problem. Is this Fed sledgehammer is revolution. It's that unique in the midst of a global economy that's tilting towards recession. So to me, that's how macro is. But you look at this 5 or 10 years from now, and that's where I think cryptos are going to really make the difference. But I view it as like the year 2000 and the internet bubbles just starting to roll over.
Okay, let's focus on this giant sledgehammer, as you say it, from the Fed with aggressive tightening. Powell seems to be very committed to the cause, fighting inflation. I think the markets are pricing now at about 36%, a 1% rate hike at the next meeting. We have the likes of Ray Dalio, JP Morgan, saying that they also expect that the markets could tank by an extra 25% even. But you do think that the mean reversion will be upon us at some point and this will flip around. What would bring that on? Would that be triggered by a Fed pivot?
Yes, that's the key thing that's significant, Michelle. I've never seen this. The Fed will not be easing anytime soon. And it's classic human nature because now we have the benefit of knowing how far and the mistakes they made by easing too much. So that's the key thing I like to see. Looking in the rear view mirror, it's very clear the pendulum for risk assets swung way too far to one side. And looking forward into the front of where this car is going, it's very clear that pendulum is going to be swinging back significantly the other way. The Fed is a leading part of that, but it's just not going to happen that they're going to ease like they did during the 87 crash and during just when we plunged in 2018, and most significantly when we plunged in Q1 2020, because they know now they are somewhat responsible for this massive inflation. It's the key things I like to come back to, and cryptos are a leading indicator here. When it gets this macro, you have to go to the key rules of macroeconomics. Number one, inflation is always a monetary phenomenon from Milton Friedman. And number two, the Adam Smith rule of the invisible hand. And to me, that invisible hand is just kicking in massively, where you throw money at people, they buy too much, they extend, and now it's all going back the other way. So that's the key thing about cryptos. It was the most speculative leading indicator I've ever seen. It still is. I mean, on your phone, this stuff trades 24/7 globally, fluently, and it's really, it's revolutionizing how people can get access to other currencies than their melting currencies, like certainly the dollar and Bitcoin. But now it's going towards, okay, we've gone too far. 2000 we did, and then we dropped, and it took 13, 14 years to get back above that old high in equities. I see a similar case. This is 1929 and the Fed's tightening. It's very much happening that way. Look at things like crude oil. We just have the biggest pump in crude oil versus this 100-week moving average ever, crude oil futures. And now it's reverting. And what typically does is the pendulum swings back too far. And I think we're in the early days of that. So I don't think they're going to get too cheap, but I think what's the bigger thing is when the dust settles from this, because the Fed's not going to be easing anytime soon. That number one way to stop the Fed from easing is markets have to go down, unfortunately. Otherwise, they're just going to hang out and wait until that inflation goes down. And what's the best way to make inflation go down? Markets have to go down. Cryptos are just a small part of that. But that's why I think the macro is overwhelming. And I think it's, when I see a storm coming, I think it's somewhat my duty to warn people. And just telling this is my true feelings of what's happening. I ask people, and I'll ask you this, and even our listeners, what stops this? Is it going to be the Fed? Is it going to be a stronger dollar? Does the dollar has to reverse? No. Is it going to be global economy coming out of it? No. Is it going to be China coming out of it? Very unlikely. I don't see what stops it at the moment other than risk assets going lower and reaching a lower plateau and us resetting.
All right. So it needs to get a lot uglier before it can get better, is what you're saying overall. But how does this play out in terms of a timeline, do you think?
Well, that's the key thing. I'm afraid we're going to have a second half similar to 2008 when things went down really hard. But then they came back. They bottomed, S&P bottomed in March in 2009 and came back. But to me, this is more the enduring correction that everybody knows we're overdue. The Fed's taken away the punch bowl that's worked for 40 years, and we just need that reset. And we had the best, I would say, foundation ever for that. The plague just put too much liquidity in the market. The key thing is, I think, is let's look forward to where's the opportunities here. I fully expect this massive backup in bond yields is going to stop and create a great opportunity. That 40-year bond bull market, I don't think it's over now. I've been wrong. I've been too early. But that takes the Fed has to stop, because I think this is going to be very deflationary. Just look at crude oil. The price on the screen right now is the same price as, I think it's October 2007. Imagine if we said that in the stock market. But I think that's what we're going to do. We're going to look back and say, okay, the stock market's the same price as it was 5-10 years ago. No, we haven't said that in a long time. I think the things that are going to come out ahead is Bitcoin eventually, because Bitcoin's going to transition to a trade more like gold in long runs. And that's the key thing why I wanted to bring gold in today. The fact that gold's down 2% on kind of a meh day is indicative to me of people just hitting their stops. Just get me out. And I think, gold should come out ahead, but this happened in 2008. I think this is the big one where, I'll give you an example. 1929, the stock market went down 50%. Then it rallied 50% up to 1930, and then everything went bad. And unfortunately, for the Fed to stop this sledgehammer, risk assets have to make them stop by tightening for them.
But yet, as you point out, a hedge against inflation, a store of value asset, a safe haven like gold is also tanking today.
There's a lesson I learned working at some hedge funds. And one hedge fund, my hedge fund manager told me that lesson is bear markets can take money from everybody. This is the worst I've ever seen. I mean, I've never seen bonds and stocks go down this much. And I hear on a global basis, it's one of the worst ever. And it's early on. Right? I say it's early on because I keep asking myself, what's going to stop it? Not the Fed. We need to see that pivot. I don't say they're going to ease, but at least for them to signal, oh, we're done tightening. Inflation's not going to be a problem. We expect it to decline. And if, stock market, we wake up one day and it's down 10%, maybe down 10% another day and 10% another day, that's what happens. That's what we typically, I think, need to shut off this sledgehammer. Right now, the fact that everybody's losing is just going to stop the ability to buy stuff, as Jen Bianco says, and that's what we need. And we're not there yet. That's the problem. The data that's still coming out is people are still buying stuff and boosting inflation. Even housing, the housing is starting to look really, I looked at some housing numbers today, and to me, it looks worse than it was in 2006 before it dropped and didn't bottom until 2011.
Okay, I want to bring it back to Ethereum now, because I know very big picture, you are very bullish on Ethereum after the dust settles, after the mean reversion. So let's talk about some of the positive aspects of this merge here, because as you've pointed out, it does address a lot of the ESG concerns, given that the proof of stake protocol is so much more energy efficient, and it could bring in a lot of institutional interest, which is then, of course, expected to drive up the price. Bank of America, one of many in agreement, saying that the merge could increase institutional adoption, and not only because of the ESG angle, given that it's now likely to be more energy efficient, using about 99.9% less energy, but also because of this idea that big companies can now stake E and actually generate income off of this. So explain how you see this whole institutional interest now playing out, especially in the context of the macro environment.
Well, that's it. 2 words: cash flow. When you can, we published, my colleague Jamie Coots, who's based in Sydney, published on Ethereum and its potential cash flow. That grabbed the attention of a lot of people on the Bloomberg terminal who are equity based. I mean, I can get involved in this nascent technology. I mean, I saw what happened in Blockbuster. I saw what happened in Kodak and everything. And get cash flow, and I can do discounted cash flow analysis on it. That's what brings in the massive institutional spending space. Slowly, it's trickling in, but that's where Ethereum is very attractive. And what it does, the utility of Ethereum is phenomenal. I mean, what stops tokenization of all assets? Yes, regulation is short term. So that's what I think that's the key thing. It brings in that cash flow. ESG, yes, I'm afraid of potential bumps in the road, but that's the key thing when people say ESG with cryptos. I'm like, you got to remember the S and G when it comes to Bitcoin. I mean, I just hear constantly from my colleagues overseas that, Mike, this is a great way for us to diversify. And I even hear it from, clandestine sources in China that we can get access to the dollar and other currencies than our yuan through our phones, through this great technology. So from an American standpoint, where, money is like water to a fish, the rest of the world understands this, and that's where I think the U.S. regulation is not going to mess up. Now, we mentioned Mr. Gensler seems to be the number one person who's an issue with cryptos at the moment, and we'll see how that works out. I hope he hope he understands how history might judge him,
right.
And that is this fact that this space has the world's most unique example of global free market capitalism I've ever seen. And on a base, everybody can get their phones and trade it and do anything. And it's gone for the dollar organically. Like I said, the most widely traded cryptos on the planet are the U.S. dollar. New tokens. To me, that's profound. The U.S. regulations and leaders see that are probably not going to mess that up. And to me, that's where it's all going to go forward, big picture, positive. In the meantime, look over to your right. What's the Fed doing? What's the stock market doing? They're going down. And cryptos are just the highest volatile, whip them around assets. So they're going to go down with the tide, but then they'll probably trade much better when things recover.
Well, you mentioned Gary Gensler, the head of the SEC, and we just discussed how the staking feature creates cash flow for Ethereum holders and how that's going to draw in more institutional investors. But on the flip side of that, Mike, it's also expected to draw in more SEC scrutiny and possible regulation, because the staking feature could make it easier to classify it as a security under the criteria of the Howey test, given that it could now be seen as an asset bought by investors hoping to earn a return based on the efforts of others. Ethereum could now be seen as a security. So what are the implications here?
That is a little more complicated. I think most people in the space would just give us clarity and we'll figure it out and move forward, because the technology is moving so fast, it's hard to dispute. But the definition of a security is, I'm not the legal person, but there is people who did make Ethereum and other people, they made it so we can benefit from it. There's people behind it. Bitcoin's not. Bitcoin's completely independent. It's the most unique asset like gold I've ever seen. In fact, it's a better version of gold. So the key thing I'm hearing is just clarify the regulation. But the stuff in the macro that's really I see important is like it's the bipartisan, the Lummis-Gillibrand bill, stuff like that, bipartisan, Democrat, Republican. It's like they're all under. It's like the best way to unify a country is have a common enemy. Well, I'll get it that best way to succeed in politics and things now is you kind of got to be positive crypto if you want money. And it's great for the U.S. because it counters China because of the dollar. So that to me is a macro. It's going to work out. In the meantime, the sooner we can get some good clarified regulation, the better. And I think most of it's quite positive. But as far as being a security, okay. I let the lawyers work that one out.
All right. Well, fighting for a common cause in this divisive political environment. How novel, Mike, how novel. And, if crypto is it, then more power to it. You mentioned, of course, Bitcoin. And one of the questions out there is, what would the merge impact mean for the price of Bitcoin, especially if it now addresses the big ESG concern? Do you anticipate that we could eventually see the flippening where the market cap of ETH surpasses that of Bitcoin?
Eventually, but in this environment, for that to happen, you need a risk-on positive macroeconomic environment. I don't see that for a while. What I see is Bitcoin becoming more like gold and long bonds in an extended deflationary recession. And I think that flipping is way too ahead of itself because I see risk assets having a problem for a long time. Bitcoin differentiating itself and becoming more like gold and long bonds. And I think people are seeing that. So eventually it probably should happen, but not in this environment that I anticipate. Now, that's my base case. I hope we get to an environment where we go back to those good old days when the stock market goes up on bad news because the Fed's is going to ease. But I think those days are over. I think that's what's happening. The Fed has realized we have our chance to go back to the days where risk assets go down on bad news and up on good news, and don't go up just because the Fed's going to throw money at it. And that's what's happening. That's where Ethereum's kind of more highly correlated to maybe the NASDAQ. And I think Bitcoin's going to migrate towards long bonds and gold. In a deflationary, elongated recession, I think Bitcoin will come out ahead. So I think it's a while for that, but it is a trend. I mean, Ethereum has been, moving forward with Bitcoin forward, but right now I think it's just a little bit expensive versus Bitcoin because of all the hype around the merge. And it's probably going to come back for a while relative to Bitcoin.
So safe to say that you anticipate this crypto winter lasting quite a bit longer then?
Well, that's the thing. It's not a crypto winter. It's a macroeconomic global winter as bad as beginning in 1929. I think it's that bad. Now, I have to express my views because I think it's that bad. Bitcoin and cryptos are a small part of this space. Look what's happened, how much wealth we've wiped out of bonds this year and how it's stocked. It's many X's times the amount of wealth that's wiped out of cryptos. The key thing is cryptos are the fastest horse in the race. They have the rapidly advancing technology advantage. And looking forward into the future, they will continue to appreciate. But now it's, to me, like I said, it's like 2000. Everything's going down. And actually even worse in 2000 because the bond market actually traded well then. And cryptos are just, they showed us this was very speculative excess. I mean, that's one thing I wish I'd been more astute about was when I saw Doge and Shiba Inu were just being silly stupid, that meant the whole space was. And now we're going back to building really good true markets without the excessive speculation, which is bad for some people. I mean, they're going to take the pain. If they're young, that's fine. It's actually good to take it when you're young and the gain later. But to me, that's the macro. Remember, it's not crypto winter, it's everything winter. And that Fed sledgehammer is making sure it is. They have to reduce inflation. And the best way to reduce inflation, most notably shorter term, is make markets, most notably the stock market, go down at a high velocity.
What if, for example, Mike, we had a peace agreement between Russia and Ukraine? Could that be a factor that sort of changes things in the sense that markets could rally on that news, that could ease up some supply concerns, supply chain concerns? Yeah. Would that be something that could be a leaf of spring in this everything winter?
That would really help. It would be very deflationary for commodities, which would ease up on the Fed. It would help globally. It also depends on what kind of peace, because we all know if Mr. Putin is anywhere around or alive, it doesn't matter. The thing is, the world has realized that this person with any type of power in Russia is just a serial liar. We can't trust him. That's a fact. That's not, I'm just quoting other leaders. So it'd have to be a definitive type of peace where that leadership is completely gone and there's some kind of more democratic voting in Russia system that will not be expanding into, taking out their neighbors. So that's very extreme, very unlikely. I'm more worried about what happens when an animal gets caged. It can reach out and lash out, and that to me is the bigger risk. But yeah, peace would be wonderful, but it have to be definitive peace, similar to what happened after World War II.
Okay, so a diplomatic solution, not very likely in your opinion, and not likely to actually be something that can turn this around, or a diplomatic solution that sees the result of no sanctions, everything being lifted, and a whole different outlook there. So, Mike, what does it look like then? All right, you're painting this very bleak picture.
Yeah.
What happens? How long does this play out for? How bad does it get? At what point can we expect things to turn around? What could trigger that turnaround?
I think it's going to be worse than the 2008 correction, worse than the great financial crisis. The foundation is there for something worse. The key thing is, remember what happened. The Fed started easing in September 2007, and then they added massive liquidity. They cannot do that anymore. The world has changed. This is going to be elongated. It's going to be deeper than most people expect. And I think this great resignation we're seeing is going to be the great begging for jobs back. And just, unfortunately, it's just a classic pendulum swinging. And it's everything. And that's why I'm a commodity strategist, but you can't ignore the macro. And this is one of the most significant I've ever seen. So you have to look at, right now, I says, what stops this early process? And I'm always looking for the triggers. So just recently, what happened with gold, what happened with FedEx just missed. To me, those triggers are just like it was in 2008, early days before Lehman collapsed. I'm thinking more worried about the dominoes falling of the next major, over leveraged, whatever. I mean, look what happened in Chinese property. Everybody knew it was over leveraged for 5-10 years. Finally, it's imploded. It's all, dominoes are just tumbling. And something, I don't know what stops it, what saves it. Definitive peace in Europe would help. But remember, we've had a plague. Now we have a war. We had major drought. It's just the whole world's tilting towards recession. And it's not even, it's still early days.
And we still have many, many other geopolitical tensions that are escalating or certainly haven't been resolved. China and Taiwan up on that list. Yeah. But Mike, I want to try to be a little positive here. Yeah. You said in an interview on Kitco in October of 2020 that Bitcoin is on track to hit $100,000 by 2025. You said the same thing in June, that Bitcoin is on track to hit $100,000 by 2025. That's only 3 years from now. And you said nothing needs to happen for this to occur. Are you still sticking to this view?
Oh, yeah. I think it's going there. So here's the key thing about Bitcoin. To me, it's a matter of time it gets to 100,000. The key fact is buy code supply is going down. Can't change it. Adoption and demand are increasing. Unless you expect that to reverse, which I don't, I think it's going to accelerate. Every sign I see is it's accelerating. It will continue to appreciate. It's just a matter of time. Right now, I think it's at that point where it's getting to very low prices. We should look back from the future as a very low price, like we look back at the NASDAQ from the bottom in 2002. But this is a different type of asset. The positive that's coming out of this is phenomenal, Michelle. It means those days where people like me would say, oh, there's nothing to analyze because the Fed's easy and throwing money at the system and that's all that matters. Those days are over. It's back to really good building solid businesses, no more zombie companies. If you go under, you go under. Bankruptcy can be good, and we get out of this. So that's the period I'm looking for. Once we get through this period of just a little bit of cleansing of the excesses of excess, we're going to be back to a world where, number one, the U.S. is completely dominant. Look at the U.S., world's largest energy producer, net exporter, world's largest agriculture net exporter. How did that happen? By adopting technology. 10 years ago, we were the largest net importer. So this is so much good coming out of this. It's just we have to get through the pain first. The Fed knows it. Most people are starting to figure it out. And I think that's why every time you see decent rallies in the stock market, you're going to see selling, and then we're going to reset. But remember, the future is going to be stock market's going to stay going down on bad news and go up on good news. And I've been so looking forward for that day. And this is the inflection point for the Fed to make it happen. They will not pivot to be too easy because they don't want to go back to those bad old days when everybody just looks at them to save them every time something goes slightly wrong.
Well, you have a lot of faith in the Fed that they're having the gumption to weather out this storm. Finally, Mike, I know you're not allowed to give investment advice per se, but which assets are probably the best way to weather this coming crisis?
Well, I have been wrong, but I do think one of the best assets to come out of this is U.S. Treasury long bonds as we head towards deflation. Been wrong. But remember, the thing about long bonds, you always get back to par. And I think that's going to go, and yields will drop significantly as we head towards that type of deflation environment. Gold and Bitcoin. And there's nothing wrong with cash. There's a good thing about it. And that's the key thing I think the history books are going to say is, remember that thing called Tina? What it did is just push people into risky assets. Cash can be okay when everything else the tide is ebbing and you're not going down. So right. I think if there's any time to be cash heavy and ride out the storm, and look to, I just like the good old treasuries. I do think they're going to be one of the better performers as we get out of this, and then surprise most people because they're just going to go back to the long-dated, lower yield trend that's been in place for 40 years.
Do you have a price outlook for Ethereum? You say Bitcoin hitting 100,000 by 2025. Do you have an outlook for Ethereum by 2025? My
colleague wrote something where he said fair value looked closer to 6,000. It's time frame that matters. To me, it's a matter of time. It makes new highs. I just don't really know yet. That's the thing about Ethereum. It's so much more difficult to measure supply demand, and obviously with the merge. With Bitcoin, you just realize the whole world says, okay, well, this is a better form of gold. It's kind of a good complement for my bond portfolio and everything else. I got to have part of this. Ethereum's so much of a different animal, but that means it has much more upside if it succeeds, and I think it will. Again, the thing about Ethereum, it does have a little more competition, but it's the dominant.
So finally, Mike, what do you expect from the Fed at the next meeting? 1% rate hike?
No,
75
they're going to go
basis
75
points?
because if they go 1 and we get a stock market crash, which I do expect can happen, the Fed will be blamed. And they know that. Between 75 and 100 basis points, it doesn't make a difference. They warned us 75, go 75. And then if the stock market keeps taunting, they see more inflation, just go 75 again. But if they go 100 basis points, they risk being blamed for a stock market crash, which I think is coming.
It's coming anyway. All right, Mike, well, hang on tight for that. Thank you so much for joining us. Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Really appreciate it. Thank you.
Thanks for having me.
And thank you for watching Kitco News. I'm Michelle Makori. Keep it right here.